This conference will now be recorded.
Good afternoon. This is Matt Mayers with Hunter Street Investment Advisors. I want to take a moment to say thank you for joining our tax workshop today. We greatly appreciate your time. I went ahead just for the sake of time, because I know we're between the lunch hour here, and I want to make sure that we cover all the information. I went ahead and muted everyone's lines. And what I'm going to do is, as we complete the presentation in about 20 minutes or so, I'm going to take us off mute so we can have an open question and answer. So I appreciate your understanding of that. So thank you so much for joining. I'm going to try and do the best I can to make taxes an exciting subject for you today. I know it's difficult, but we're going to really try and do some things that hopefully some of these you may know, some of these you may not. But these are some great ways that we have seen our clients be able to save some money within their taxes for the year. So again, my name is Matt Mayers. You may or may not be aware from my thing, I am not a CPA, and I'm certainly not going to provide direct tax advice to any one given person today. And I don't prepare taxes, but we are a very tax-centric firm. I am the lead financial planner at Hunter Street Investment Advisors here in Apex, downtown Apex. And one of the things I do a lot of as well is I coordinate with our clients through CPAs to work through tax optimization throughout the year. So that is my focus of today's conversation: is taxes, taxes, and taxes. I would say that we may not prepare taxes, but there's a lot of things that you can do to optimize taxes throughout the year. So, and you see on my first screen, I have after the Tax Cut and Job Act, after the Secure Act, after the CARES Act, the American Rescue Act, and I'm sure there was probably another act in there I forgot. But there's a lot of acts that were passed over the recent years that basically changed tax laws. And there's so many, it's hard to keep track of them. So my thought of today is just to kind of give you some ideas of things that I've seen work. These things work for our clients. We talk about them proactively. We talk about them before the end of a tax year and after they get ready to file, and we see what we can do after. These are proven strategies that can hopefully help you out in the long run. I am going to have my contact information on after we do our Q&A. I would encourage you, if there's something that you want to talk about personally with your individual scenario, please send me a message in the chat. There's also going to be a way to schedule with me at the end. As these are complimentary, of course. We'd love to be able to sit down and see if we can help you in your individual scenario. So now the goal of today, as mentioned, is to do a couple things. We first want to understand some of these recent changes, and some of the ones that went back to maybe 2021 and 2020. Look at the tools and the strategies that we can use to reduce or potentially reduce income tax. And then lastly, what do you do with these strategies? Now that you understand them, how are they applicable to your individual scenario? So first thing I want to share, and I won't go over this too long because it's a lot of information, and most of it you probably already know, but the tax brackets do change ever so slightly every year. So I put up here the filing status for single for 2021 on the left, and then 2022 on the right. So I just want to share with you a quick example. It's going to work the same for married filing, joint, and head of household, and other things too. The numbers will be different, but it'll work the same. The bandwidth will stretch a little bit. But you'll notice, for example, in 2021, if I was a single filer and I had, $9,950 in income, it would be at the 10% bracket. In 2022, it's going to be $10,275. So the bracket itself is widened a little. We're getting a little more space. I do think it's important to understand about the brackets too, because we have some people that say, well, Matt, I made a lot of money this year, and all of my money is going to be taxed at 22%. That is not the case. So my example would be is if you look at the left-hand side, let's say, for example, I'm doing my taxes and I say, okay, I made $40,525. So per that taxable, that second column, that puts me in the 12% bracket. Okay, it means that basically my income is going into the 12% bracket. So the first 10% of that first 9,950 is not taxed at 12%. Okay, it's taxed at 10%. And then we go basically from 9,951 to 40,525. So let's say, for example, filing my taxes, I think I'm at 40,525, and I find an extra dollar. And I go, oh no, I'm at 40,526. Now that puts me in the 22% bracket, but that does not mean that I pay 22% on all my income of 40,526. So it's a progressive bracket. So I do think that's important to know as you're planning on kind of what it is. And that's, there's the bracket that you fall in, and then there's what's called the effective marginal rate that you pay, which is going to blend together the brackets and give you exactly what percentage you're paying for the year in taxes and the tax rate. If you've never had that done before as an exercise, that is something we love to help you out. We'll kind of take a look at where you're going to land for the year. I also want to know, I want to know before the end of the year that if I make a raise or I get this, or if I sell this or I sell that, what's that going to do? Because that's going to be all income dumped on top of me. And if I'm not planning for that, that could potentially put me in the 22% bracket where I feel like I'm comfortably safe in the 12. So these are things that I would ask you to consider as you're going through the years. Planning ahead is crucial to be able to provide tax optimization for you. So I went through the married filing joint brackets are very similar. So again, they're a little bit wider because the deduction's a little bit higher, the brackets are a little bit wider, but it still works the same. So we won't talk too much about that. I do like to stop on here for a second because, and this is again married filing joint brackets for 2022. Nothing against single filers, but just to keep it simple, I wanted to put in red. So those are the brackets for 2022. For example, 0 to 20,550, it's a 10% bracket, and then 12, 22, 24, 32, 37. The red is where they were before we had the tax cuts by Donald Trump, by President Trump back in 2017. So when people say we're paying a lot in taxes, we may be because hopefully everybody's making more income, but this tax rates are still at a discount. And I tell you that because regardless of what happens, we can't control Washington and what they do with taxes, but we have our current tax rates right now, at least until the end of 2025, unless Washington decides to do something different, which I don't think they're going to do. It's very political out there these days. I'm sure you're all well aware of that. So at the very least, we'll have these tax brackets until the end of 2025. And if nothing is done, they'll revert back to what you see in red in 2026. So I tell you that because if there's these years, whether you're making more income or you can potentially do Roth IRAs or you can sell a stock or whatever it may be, the tax rates are still at a good discount. So I would say take advantage of what we can over the next 3 years while we still have these rates before they could potentially go away. And considering the debt we have as a nation, who knows what it's going to look like in 2026. So that's what I would look at. Capital gains is a little bit different. Everything else I just showed you was for the earned income you have, money you're making from salaries, pension plans, things like that. The capital gains brackets are driven around things you sell. So my example would be a stock. If I purchased Apple stock in February of last year, 2021, and let's say I purchased it for $200 a share, and then I sold it in December for $250 a share. I've gained 50, correct? So if I've done that and I've sold within a year, I have to pay taxes on those gains, and I pay them at those brackets that I just showed you a few moments ago, your personal income brackets, your ordinary income brackets. Now, if I held that stock until February this year and hit the 1-year anniversary, I would pay it on these bracket rates in capital gains. So, these are things to look at when looking at just kind of taxable income, and they're very similar for, where, for the income aligned. So your taxable income is really what decides how much capital gains you would pay. But I think the key to this is that 0% just jumps off the page at me. If I'm married filing joint and I make $77,000 this year and I sell something for $50,000, the stock or something like that that has appreciation, yes, that's going to be added to my income. Okay, there's no way that won't be added onto my modified adjusted gross income for the year. But I'm not going to pay 15% on all of it. I'm only going to pay 15% of it on the part of the bracket that touched it. So those are things to look at when looking at these brackets. Is if we can kind of look at different things to do and then be able to potentially get a zero rate on some of that stuff, a great time to be able to look to do these things. So that's capital gains. That window, as you can see in 2022, has been stretched out a little bit from 78,000 to 83, as the brackets typically would. Deductions, and I'm going to go through some of these real quickly just because I want to get to some more of the important stuff. But deductions are different than credits. There's a lot of things about credits going on now. We have the child tax credits, the earned income credits, education credits, savers credits. Deductions are different. Deductions are things that take away from your taxable income. Okay, so it takes right from your taxable income and puts you in a lower income bracket, or could put you in a lower income bracket. Credits are different. Credits, basically, when you get your total tax due, it just takes off that amount. It's just a credit. Now, some credits are refundable and some credits are non-refundable, which we'll get through here in a second, but deductions are different. So the standard deduction has been raised this year to $25,900 for married filing joint and $12,950 for single in 2022. Itemized deductions are things you can do on your Schedule A. Your mortgage interest on debt up to $750,000 is still in place. Again, you can't include the home equity line of credit that we used to do back prior to 2017. Charitable gifts of cash or check, you can do still in 2021 up to 100% of your income. It was at 60% of your income, but the COVID Act was able to move that up to a full 100%. And you can still do above the line deductions for cash contributions up to $300 if you're filing single and $600 if you're filing joint. So, there's some things out there that are still carried. I tell you that because there was some things that happened in the charitable contributions. Those things changed from where they were from when Trump cut the taxes to the years we went through COVID. These were things that were added during COVID that were still there and were still applicable. They carried over to 2021. Now, whether they stay past 2021, and there's a lot of talk about what's going to be put through the taxes forward. That's more of a Washington thing. But right now, if you're filing for 2021, you still have it. So credits. There's Savers Credit. I'm going to talk a little bit about the Child Dependent Credit and then the Earned Income Credit. I'm going to spend a lot more time on Child Dependent Credit today because I think that's more applicable to everything we've seen this year. But Savers Credit is an interesting one. Basically, this is a non-refundable credit. Okay, so even though it's called a credit, if at the end of the year I'm due, I have a total tax bill due of $5,000 and my Savers Credit is $2,000, then it would just reduce it to my tax bill of $3,000. If I owe, let's say I owe $500 for taxes and my Savers Credit's $1,000, I'm not going to get a $500 refund because Savers Credit is non-refundable. It's just going to take my tax from 500 down to 0. Okay, that's different than some of the other benefits. Child Dependent Care is refundable, meaning you could potentially get a refund from it, and so is Earned Income. But the Savers Credit's a little bit different. Basically, if you contribute to your retirement accounts, your traditional IRAs, and you put a certain sum of money in, if your income falls through a certain level or below a certain level, you can get up to $1,000 credit for single filers and $2,000 for joint. Now, your income has to be under certain levels. So I would say if your income's under $66,000, if you're married filing joint, if it's under, I think it's $33,000 if you're single, then that might be more applicable to you. But that's something to think about, especially if you are contributing to your retirement accounts. So I'm going to dive into kind of the Child Dependent Credit as a way to look at, kind of what we can experience this year with regard to some of the things that changed during COVID, because there was a big change and lots of questions around this. First, you may have already received this, the IRS letter 6419. This is basically if you received advance payments, whether it be the form of the stimulus package or the child tax credits. If you receive that, you should be getting a letter in the mail telling you, it's letter 6419, if you haven't gotten it, you will get it soon, what you've taken in 2021. So it's a great way to do a checkup and say, okay, if I know that in 2021, I qualify for $6,000 of child tax credits, I was probably fronted to $3,000, half of it, and now I can claim the other half. So when you get that letter, it should say you've taken $3,000 of your child tax credits and you're owed this much more. Or if you took a stimulus, it'll say for your stimulus, you got $5,000 in 2021. So definitely keep that on hand. That's what that is. If you hear 6419, you should be getting that if you receive any payments from the government. So the child tax credit, this is the biggie. Basically, the big change was during COVID for the year 2021. The new administration kind of brought this out, is that you can basically, the child tax credit, first of all, that's nothing new. The child tax credit's been around forever, not forever, but for quite a while. But they increased the amount you could take per qualifying child from $2,000, okay, to basically $3,600 for children ages 5 and under, and then $3,000 for children ages 6 through 17. Okay, so that's a big jump. It's a $1,600 jump for younger children and a $1,000 jump for older children. The catch was that it's all based upon the income that you've made or the income that you're making. So now they're looking at 2020, 2019, and eventually, as you go to claim maybe the remaining portion of your credit that you didn't get last year, your 2021 income. So I want to talk a little bit about how this phases out. There's a lot of confusion around, oh, well, I'm not going to get anything back, or I should get this full back, and I'm not projected to get my full amount back. There's 2 phase outs for this. Phase out 1, okay, can reduce the credit back to what it originally was before the credit was changed by the administration. So it brings it right back down to that 2,000, okay, and then basically it brings it down to 2,000 for children ages 5 and under, and 2 for ages 6 through 17. So it basically just takes away the extra money that we're given. So that's the first thing. The second phase out can potentially reduce below that 2,000. So think of it in 2. The first one is it's going to take away the extra money we were given, and the next one can start reducing what you would automatically qualify for regardless of what happens. So the way this phase out goes, and I know I don't think there's a lot of words on the screen, but I do think it's important to kind of look at the two phase outs. So basically, if you're in phase out number one, okay, and if you're over 150,000 filing joint, 112,000 filing single head of household, or 75,000 if you're a single filer, basically you're going to be reduced back to the 2,000 that it would have been. Okay, so it takes away the extra money. The key to this is we did this last year. So the government, if you were qualified, I use the example, if I qualify for a $6,000 2021 credit, the government would have fronted me, if I qualified, $3,000 in between June of December of last year. That stopped, but I can claim the remaining $3,000 on my 2021 tax filing. But if my income is increased, that might not be as much, because I might be looking to, it might be breaking in. Now that my 2021 income is here, if that's increased, I might not qualify for as much of the benefit. So there's a potential that it could be reduced. Okay, so that's number one. Then number two is and this is the biggie, because there's a big thing. Well, if I get over a certain amount, it's going to be completely gone. It doesn't completely go out. It doesn't completely go out of the door completely unless you start making more and more money. Okay, so the second phase out would be 400,000 if you're married filing joint, and then 200,000 if you're filing single or other status. So the second phase out basically reduces the credit by $50 to reach $1,000 by which your adjusted gross income exceeds the income threshold. So those are the way this is being calculated. I think it's very important. Now, if you're using TurboTax software or other softwares out there, they must be already calculated. If you put in that amount from your form that you get from the IRS, it's already going to calculate what you can get. So, but if you're seeing a difference in that, or if it's reduced, it's possibly, or if you're even seeing an increase, if your income decrease, it could potentially be lower or higher based upon what you're filing in 2021. So that's the first thing. So really what I wanted to spend some time on is how can we reduce tax? What are some of the things that we have helped our clients do to potentially reduce their taxes, either throughout the year leading up to December 31st, or after the 31st and to your tax filing deadline of April 15th. The first thing is the easiest, which I won't spend too much time on. It's just W-4 withholding. So obviously your employer gives you a check. It allows you to kind of withhold certain tax from that check. My thing is, if you're getting a huge bill this year and you don't want a huge bill next year, it might make sense to raise your withholdings. Okay, and have them take more tax out. And that's going to be, I would say, if you're working with a CPA, that's a great question for them to have. If you're not with a CPA, you can certainly work with one of ours to kind of get that, just to kind of see what that W-4 withholding should look like. And if you're getting a huge refund, do the exact opposite. Reduce your withholding. Okay, otherwise you could be needlessly living on less of your paycheck than you have to be all year. So that's the first thing and the easiest thing. And that typically has to be done in the beginning of the year. The next thing is 401k contributions. And this could be 401k contributions. It could be 403b if you work for a hospital or a university. Basically, if you're, think about this, the pay stub that you get every time you receive pay as your pre-tax contributions and your after-tax contributions. And the after-tax contributions, we're not going to talk about today because they don't really take anything. They don't reduce your taxable income at all because you already pay tax on them. But the pre-tax do. Okay, so if you're contributing and you have access to a 401k or some type of qualified plan, I always suggest to our clients to make sure that you're investing in these up to what the company's matching. So if you have a match of 5%, we love to see our clients match 5%. Not because we want them to see them, not because of anything more than it's free money from the employer, and that money that you're putting in there reduces your taxable income. It comes out pre-tax. You'll notice that on your line for pre-tax contributions. So the good news is in 2021, they've increased the amount that you can contribute to your 401k plans or your 403bs. It jumps up now to $19,500, and that was actually, that was 2021. In 2022, it's now $20,500. So we have an additional $1,000 that we can contribute to our retirement plans and reduce all of our taxable income. That's a nice chunk. If you're 50 or older, you can contribute the extra $6,500 for a catch-up. So the good news here is this is a great way, and I'll give you a couple of examples. I'll give you an example of how we use this. We had several clients last year that were going through life transitions, and they pay for larger expenses, so they decreased the amount they were basically withholding from their checks, this kind of W-4 withholding, and decreased the 401k contributions until the later part of the year. If they hadn't, their income raised dramatically at the same time. So they were able to get raises in better positions, and suddenly they're staring at, 6 months out, we're staring at a pretty potentially high tax bill if we don't make some changes. So we're able to go in there and calculate how much can they put in 401k between June and the end of the year to reach their max, and that comes as a dollar for dollar reduction of their taxable income. So the 401k is a great thing to have. Now you have to make contributions to a 401k by December 31st in order to reduce your taxable income. You can't do it after the end of the year. So it's something that you definitely want to put in motion sooner than later throughout the year if you're not doing it already. Okay, next thing would be is traditional IRAs. So these are things outside of your employer-sponsored plan. So traditional IRAs, and there's Roth IRAs too, but we're not going to talk about those today. That could be a whole other conversation. But Roth is important. I would say if you don't have a Roth or you're wondering should you have a Roth, these are things we can talk about as well offline after the conversation. If you look at traditional IRAs, these are things outside of your company, your individual retirement accounts that you can contribute to per year. So you can contribute, so 2021 and 2022, you can contribute $6,000 per year to your traditional IRA or your Roth IRA or some combination there, but it's $6,000 for your IRAs total. So $7,000 if you're 50 or older. So that stays the same for 2022. But here's the catch. If I'm coming in and let's say I have a 401k in 2021, I contribute to that, I max that out, and I have a traditional IRA that I put $3,000 in 2021. You know, end of the year comes, now I'm now preparing my taxes, and it looks like to me I'm going to have a little bit higher of a tax bill. What's nice is I still have some room in my traditional IRA. I only put in $3,000. I can put in another $3,000 to get to my limit. As long as I do that between now and April 15th, that will decrease my taxable income. Okay, so, you know, and that's depending on how much tax savings is going to be driven by your individual scenario, but it's nice to be able to say, okay, if I pop in another $3,000, that's going to come off my taxable income and hopefully can maybe reduce that tax bill a little bit. So a traditional IRA is something you get to contribute to after the fact of the year up until the tax filing deadline and still potentially reduce your taxes. So it's very important. And there's some, I should say before I go, there's some income limits to this. So not everybody can qualify for it. So 2021, if you were married filing joint and your income was more than 125,000, you couldn't take a deduction. In 2022, it's 129,000. For single filers, it's 78. So if you're over these limits, you might not get, they start phasing out at a certain point, but if you're over those limits, this would not be applicable to you. So that's always key too, is looking at kind of where you should be structuring your investments throughout the year based upon the income numbers that you're making and different investments that you have beyond just your 401k and seeing where there's ways that you can save taxes. So the other thing is flexible spending accounts. I know these are nothing new, but basically you're putting tax-free dollars from your employer to a flexible spending account, and that's reducing your taxable income as well. In 2021, you could put $2,750. In 2022, you could put $2,850. The one thing I've never liked completely about flexible spending accounts is that if you put that money in, let's say I put $2,750 in and I don't use it this year, it doesn't roll over to the following year. So I have to be ready to use it within the confines of the year, but it does reduce taxable income. There's one thing that I like better than the FSA if you have the ability to do it, and that's the health savings account. Okay, the HSA. Some people get them confused with two different things. The main difference between the HSA is that if you don't use it, it still rolls over. You don't lose it. It's not a use or lose it scenario for a given year. And the key to this, let's say the rules of the road, is you have to have a high deductible healthcare plan in order to have access to an HSA. Okay, so high deductible plans for 2021, basically all you're simply meaning is that you're paying lower premiums and you have to pay more out of pocket. That's all it simply means versus higher premiums and less out of pocket. So if you have a plan that has for 2021, and this is actually for 2022, if you have a plan basically where you have a deductible that's at least $1,400 for individuals and $2,800 for family. So $1,400 for individuals and $2,800 for family. So your deductible, and then basically your total out-of-pocket expenses can't be more than $7,000 for individuals and $14,000 for families. Okay, and that's going to go up to $7,500 in 2022 and $14,100. So the key is if you have plans that fall within those guidelines, the high deductible plans, you will have the ability to contribute to a health savings account. You may already have one, maybe your company offers and you just haven't used it. So there's the single account and then the family account. So if you look in 2021, if you basically had a single account, you can contribute $3,600 a year. If you had family plan, you could do $7,200. That's going to go up to $3,600 and $7,300 in 2022. And the difference of this is driven by how are you married or are you single, how you're filing your taxes. It doesn't mean that I was going through this conversation with somebody who's a single parent the other day. It doesn't matter if you have a dependent one year and then you don't have them the next year because your ex-partner's doing it. It has nothing to do with who you're claiming. It has to do with your filing status. So if you're married filing joint, you have a family plan, and you have the ability to do that higher deductible, or actually the higher contribution amount of 7,300 or 7,200 for 2021, and vice versa for single. If you're 55 or older, you can also put an additional $1,000 in. Here's the key, though, and no one really knows, I don't think most people realize this, is that just like we talked about with a traditional IRA, after the year ends, if you've not contributed your full amount for the year, you can contribute the extra amount you need to up until the tax deadline filing of April 15th. This is big. So, if I was married filing joint last year and I had 7,200 to put in there, but I only put 4,000, that means I have $3,200 more that I can put in between now and April 15th, and that can be coded as a full contribution for the family for the year, and that would reduce my taxable income by an additional $3,200. So these are things, if you're not aware of them, it's hard to really plan for them, and these things that, yeah, you still have time to do them after the fact, after the year ends, but you definitely think some things you want to plan out throughout the year. So definitely take a look at HSA if you fall within some of those guidelines. The earned income tax credit, I'll just touch base on a minute. This is another refundable credit, meaning that this could help you get a refund, not like the Savers credit, which just takes off your tax bill. The rules are a little complex, and again, this is more for your low to moderate income. But when looking at this, basically the general rule of thumb is that if you've earned less than $57,000 in 2021, definitely look into it. Depending on your income and your marital status, how many children you have, you might qualify for a credit up to about $67.28. So that's a sizable amount. And the way it works is that single filers, they actually changed this because the most that a single filer could get prior to the American Rescue Act that they did during COVID was $500 and some dollars, and moved up to $1,502. So if you're a single filer, you can potentially get in 2021 up to $1,500 from this credit if your income falls below a certain threshold. And then if you're married filing joint, you can get up to $67.28. So your income, just depending on where you are, single would be the single filer income max would be around $21,430, and the max again would be that $57,000. It's actually $57,414. So if you're under those are some things you can do that can potentially help you get a tax credit this year. So charitable contributions, we mentioned this in the beginning, but this is big, and I just put this up there as a reminder. It's not just about cash. You can still deduct other things. Have you donated clothes? Have you taken your sporting gears, your household items? The key is itemization, making sure you have a good record of that. In case the IRS wants some notification, but you can do all these and still make those deductions. And again, for 2021, you can still deduct $300 per person, and then married $600 per person without having to itemize. So that's big. That's still continued over. I can't guarantee we're going to have that again in 2022. Medical expenses always an interesting one. If you've been in the hospital and have other stuff, it's always good to keep those receipts. Basically, in general, you can deduct qualified medical expenses that are more than 7.5% of your adjusted gross income. My example would be, since I know it's a lot of numbers, is that if you have adjusted gross income of $40,000, anything beyond the first $3,000, okay, of your medical bills, which would be basically 7.5% of your adjusted gross income, could be deductible. So if you rank up $10,000 in medical bills, 7,000 of it could be deductible in that example. So if you're not taking a look at this and keeping good records, it's definitely something you want to consider for this year in planning. And then lastly, I'll say kind of perfect timing. Huge difference between doing something, I would say, not just on December 31st, but really the whole year long before January 1st. You can see where some things you can change before the end of the year, and some things you can change before the tax filing deadline. But to me, tax optimization happens with our clients all year long. We start in January. We continue to the third quarter to the point where at the end of the year, they're very comfortable and they know kind of what they're going to be expecting from the tax bill. My thing is, if you know an upcoming expense is going to be tax deductible, think about whether you can pay for it this year rather than next year. Can you take deduction years by paying a little more out of pocket? My other example would be mortgage payments. Can you pay January's mortgage payment in December? That gives you an extra month of mortgage interest you can deduct. That's an easy way to look at it. And then obviously the threshold for medical expenses, does it make sense to maybe move the root canal or a major medical procedure up this year so you can take advantage of that medical threshold. So these are the things we look at when we prepare for our clients. These are simple things to do, but very important and can obviously have a good impact on overall planning. So a couple things, a couple questions that a few people asked me that I know we're going to be on was just things for if they were single parents and taking a look at some things just around more of the single parent line. So, one of the things I'd say is one of the first things I take a look at is how you file. If you're single and you're filing single, that's okay, but if you're head of household, if you pay them, if you're paying more than 50% of your expenses and you're unmarried on the last day of the year, and you have a child that lives with you more than 6 months, you can file head of household. Right now in 2021, head of household was 18,880 versus the single, which was 12,000. So there's a major difference there. In 2022, head of household was 19,400 versus the single's 12,950. So again, that's a sizable difference. So that's one way to look at it. The dependent credit, basically dependent care expenses are allowed up to 4,000 for one child, 8,000 for two or more child. There's some parameters around that would qualify you, so we'd have to take a closer look at that. And then, also education. There's the ability to have basically credits for the American Opportunity Tax Credit offers a maximum annual credit of about $2,500 per student. So there's a way based upon your income, again, all income based, that you can see if you can get tax credits. But the other thing I'll mention too is, another pre-tax option that might be available in your companies is the 529 plan, which is, the tax savings plan for kids, for children's college education. This is big. And if you have one through your employer or can invest one with pre-tax dollars out, that again is another way to contribute to, a child education account, plus be able to reduce your taxable income. So these are things that if you're not doing, again, not everything may be applicable for everybody, because obviously there's going to be different scenarios, but these are things, if you've never taken a chance, I would say if you've never sat down to think about how you can proactively plan for your taxes, other than at the end of the year, you make your money and give your tax returns give your W-4s to your CPAs, and they say, this is it, here's what you're paying. If you've never done any proactive planning throughout the year, I would certainly encourage you to kind of schedule some time with us and see how we can be helpful to you. My contact information is on the screen. Again, we're located right in the heart of downtown Apex, across from the community center, the big brick building. We love to, and we do virtual meetings as well. We do complimentary meetings. That barcode at the bottom, as you see, basically, if you click on that barcode or use your camera from your phone, that will take you right to our schedule. We'd love to schedule a 30-minute consultation with you to review your tax scenario. It doesn't matter whether you've already filed for the year and you realize, well, I should have known that. My point is there still be some things we can do proactively now for 2022. And if you haven't, I'd say that's great, because we've hopefully been able to give you some information that you can go back and say, okay, I could have done that. But at least at the very least, we talk about informed decisions, looking for blind spots. We can at least take a look at your scenario and say, here are some of the things we can look at. Do you have these types of accounts? These are the things that are good for you based upon the income that you're making. We would go through that all in a complimentary consultation. So again, I would love to see you have the opportunity, again, because I know not everybody in scenarios like this is willing to talk about personal scenarios. So we'd love to have you in the office or for virtual meetings to get to know you better, or a phone call just to see if there's something that we can do. I'm going to go ahead. I thank you for your time. I know I ran a little bit over, and I apologize. I'm trying to get through all the great information that we have. I'm going to go ahead and open up our lines for chatting, and feel free to answer any question, ask me any question that you have, or just kind of make a note in the bottom there of things that you want me to follow up with you on after the presentation.